Gabriela, come into my terminal here for our single best chart. What we're taking a look at is Brazil. Now, you had Brazil originally, their stock market here in white, just being rocked because of all the political uncertainty they were going through. And then, of course, right around here was the election when you got a big pop. And now on a normalized basis, going back a couple years, you actually now have Brazil outperforming. You've had some comments from the central bank saying that they want to remain dovish, but also highlighting that Brazil needs some fiscal reform to help boost up that part of the market. What do you see in Brazil?
Brazil's such a good constructive story in Latin America right now. So Brazil, we did have that pop during the election, even before the results, and then we got another pop once the cabinet was announced in January. And really the story there is after 14 years of a more leftist government, we now have a center-right government. That's very much favorable for business reforms, for fiscal reforms, for really getting the country back on track. And it's really been lifting local animal spirits. So businesses feeling more confident, consumers as well, and local investors really doing the majority of that heavy lifting in the market. So I feel very optimistic, constructively optimistic about Brazil this year.
Well, and one place that you have said actually is the opposite has been Mexico, which, as we've seen on a normalized basis, is in negative territory, sort of underperforming some of the other EM markets. Mexico's in the opposite camp.
Exactly, and we can see that on the chart. Brazil moving upwards versus Mexico moving downwards. Part of that is, of course, related to the trade uncertainty with the U.S., right, with the negotiation of the new NAFTA deal, but part of it is domestic as well, right? After the political elections in the middle of last year in Mexico, the country moved towards the left, so the opposite direction that Brazil went in, and that's generated a lot of uncertainty locally, especially for businesses. So we've been seeing lower momentum in Mexican growth. Perhaps earnings estimates are too high. Perhaps Mexico doesn't deserve the same kind of multiple that it used to. So I would feel much more optimistic about Brazil versus Mexico this year.
Gabriela, if you look at Brazil, though, doesn't the future of the economy actually ride on pension reforms?
Yes.
And how can we be so sure that the country is ready to be reformed?
Oh my gosh, it is such a crucial issue. The number one issue in Brazil this year is pension reform. And that's really to get the fiscal accounts in order. It's very much an urgent issue. Brazilians retire at an average age of 55 right now. And of course, in line with the rest of the world, it is a population that's getting older. So it's just plainly unsustainable. That is priority number one. And the government, President Bolsonaro yesterday announced the initial draft of the pension reform, which the market took very well. It's an initial salvo. It's an initial proposal. It still has to be debated in Congress throughout the year. But it's an issue that is in every Brazilian's mind. So it's something that I believe the general population realizes needs to get done this year.
Gabriela, if we don't see this pension reform, if it hasn't been approved, and as you say, we're just at the early stages, will it prompt a weaker currency and therefore inflation concern and a major sell-off?
Yes. Now, this it will not be approved this quarter, not even next quarter. It's probably a second half of the year issue. But investors do need to see this progressing in a favorable manner through Congress. If it doesn't happen this year, it's very much a big issue for Brazil. You will likely see yields spike. You'll see the currency weaken. As you mentioned, that's an issue for inflation, for the central bank, for the growth picture. It's a really important issue. I think can't stress that enough to get this done. But it is going to be more of a second half of the year kind of conclusion.
So much when we talk about Venezuela, it's about oil sanctions and what that means for oil supply and demand. But how are you playing Venezuela, both on the debt and the equity side, if at all?
It's hard to play. So Venezuela is not in any of the equity indices, either emerging or frontier. It is more of a debt story, but at this point, Venezuelan debt is only 1% of the emerging market U.S. dollar index. So I think, broadly speaking, investors barely have any direct exposure to Venezuela. So it is more of an indirect story through oil prices. And, of course, a huge humanitarian issue for the people of Venezuela and the neighboring countries of Colombia and Brazil, where there's been a lot of migration.
Gabriela, depending on what the Trump administration does with Venezuela, does it change your outlook?
So I think, the U.S. is putting a lot of pressure on the current Maduro government by choking off their access to dollars and by choking off its access to the U.S. market. Now, what would be very much an extra step there are some of those reports that we've been hearing about further sanctions, which would really limit Venezuela's ability to even sell oil globally. That would be a much bigger step there in terms of pressuring the local government and would be short-term bullish for oil prices, right? It's a decrease in supply. But I think longer term, this story, right, if we do have regime change, it could actually get Venezuelan oil production back on track after years of really deceleration, which would actually be long-term bearish for oil prices if indeed there is positive regime change.